The phone calls always start the same way. Warren, is this really the final stage of the bubble? People ask me, did we finally reach the top? And I always answer them with the same line. I don't predict the exact moment bubbles burst, but I do know what the last phase looks like, because I've lived through more of them than most investors ever will. I saw it in 1929, in 1968, in the dot-com boom, in 2008, and now I'm seeing it again. The patterns don't change, only the names do. And today, I'm going to walk you through exactly why we are entering the most dangerous phase of this market cycle, what I call the final stage of the bubble. Now, let me start with something simple. Bubbles never look like bubbles while you're inside them. They look like genius. They feel like destiny. They sound like opportunity. And the people making the most noise are the ones who just got rich the fastest. That's always the group giving you advice. The people who turned $10,000 into $1 million, sometimes through pure luck, sometimes through leverage, and sometimes through speculation dressed up as investment, and they stand in front of cameras and say the same line every time. This time is different. But I've been in this world for more than 6 decades, and I can tell you with complete certainty, this time is not different. The only thing that's different is how big the bubble has become. Let me explain what I mean by final stage. A bubble doesn't start with madness. It starts with something true. The automobile, radio, the personal computer, the internet, artificial intelligence, each had a grain of truth that sparked excitement, something real, something world-changing. The bubble starts with fundamental innovation. The final stage begins when investors stop caring about the innovation and start caring only about the price. When price becomes the story instead of the result of the story, that's where we are right now. I've said many times that prices are what you pay and value is what you get. In the early part of a technological revolution, prices are below value. That's when I like to buy. In the final stage of a bubble, prices are far above value. That's when I prefer to hold cash. And right now, we're at the point where investors are paying tomorrow's perfection for companies that can barely deliver today's promises. Let me give you some numbers, because arithmetic never lies. The overall stock market is trading at valuation multiples I've only seen twice before in my lifetime. The late 1990s and the period right before the financial crisis. The total market capitalization of all publicly traded companies in the United States is more than 220% of the nation's gross domestic product. That number has only been higher once, and it didn't end well for investors. Now, please understand, I'm not saying that artificial intelligence isn't real or important. It is. I'm not saying that new technologies aren't worth paying attention to. They are. What I'm saying is that investors are paying any price without understanding the math behind those prices. Companies with minimal profits are trading at earnings multiples that assume 25 to 30% annual growth for the next 10 years. Not just one company, dozens of them, some over 100 times earnings, some with no earnings at all, but with market capitalizations exceeding the size of Fortune 100 businesses. You don't need an advanced finance degree to understand that this isn't sustainable. You just need common sense. Let me walk you through how bubbles behave in their final stage. First, you see a narrow group of stocks driving most of the market's returns. Right now, a handful of names represent more than half of the S&P 500's total gains. I've seen this before. In 1972, they called them the Nifty 50. Wonderful businesses, great management, strong brands, but people lost fortunes by paying too much for them. In the late 90s, it was the dot-com darlings. In 2007, it was financials and home builders. Today, it's artificial intelligence beneficiaries and a few mega-cap technology companies. The danger is always the same. When a small group of companies is carrying the entire market on its back, the market becomes fragile. It only takes one stumble to pull everything down. Second, in the final stage of a bubble, Investors stop evaluating businesses based on their profits and start valuing them based on a story. I've lived long enough to know that stories can make you feel rich, but cash flows make you stay rich. Cash flows don't lie, stories do. And right now, I'm hearing stories everywhere. People talking about trillion-dollar total addressable markets, infinite growth, artificial intelligence solving every problem imaginable. But the math tells a different story. Even the greatest businesses in the world can't grow at 20% forever. Not Apple, not Coca-Cola, not Microsoft, not Google, not Amazon. Size is gravity. The bigger you get, the harder it becomes to maintain high growth rates. Yet investors today are pricing dozens of companies as if gravity doesn't apply to them. Third, the final stage of a bubble produces something I call forced participation. That's when investors stop asking, "Is this a good price?" and start asking, "Why? Am I the only one not buying?" They feel left out. They feel like they're missing the train. They see their friends making money, and they feel foolish for sitting on the sidelines. They stop thinking like owners and start thinking like gamblers. That's when trouble begins. And I'm seeing forced participation everywhere, from retirees shifting their savings into risky assets, to young people trading options on their phones, to professionals buying stocks they don't understand because they're afraid of underperforming. Let me give you a simple example. When people tell me they don't care what a company earns, they only care about what the stock might do next week, I know exactly where we are in the cycle. When people tell me valuation doesn't matter because artificial intelligence will fix everything, I know exactly where we are in the cycle. When people tell me cash is trash while they're buying companies with triple-digit price to earnings multiples, I know exactly where we are in the cycle. These are not the signs of a healthy market. These are the signs of a final stage bubble. And here's something else I've learned. In the final stage of a bubble, people stop asking what can go wrong. They only ask what can go right. They assume perfection. They assume smooth execution. They assume regulators will stay out of the way, that competitors won't catch up, that growth will last forever, and that interest rates will eventually fall and make everything more valuable. But investing isn't about assuming perfection. It's about building in a margin of safety. And right now, the margin of safety in this market is razor thin. We're seeing speculation, leverage, and optimism all peaking at the same time. Consumer debt is at record levels. Margin debt has surged. Private credit markets are ballooning. Corporate balance sheets are stretched. Home prices are near all-time highs. Rents are at historic levels. Government debt is climbing at a pace I've never witnessed in my life. And yet, stock prices continue rising as if none of these things pose any risks. When people ask me why I keep emphasizing these risks, I tell them a simple truth that many investors forget. Markets don't crash from low levels. They crash from high levels. And right now, we are sitting at heights that require everything to go right for years on end. That has never happened in my lifetime, not once. Every period of elevated valuations eventually comes down to earth, and the higher they climb, the harder the landing tends to be. Let me tell you what I'm seeing that reminds me of the late stages of previous bubbles. Investors are treating short-term interest rates like a temporary inconvenience rather than a fundamental reality of the economy. I often hear people say that rates will soon return to the near-zero levels we saw in the 2010s. They say it with certainty, as if the universe owes them cheap money forever. But interest rates that low were an anomaly, not a baseline. And when people build investment assumptions on anomalies, the results are rarely pleasant. If rates stay elevated longer than expected, and history suggests they often do, these stretched valuations will face enormous pressure. There's another dynamic I've seen many times before. It happens in the final stage of a bubble, and it's happening again today. Companies begin shifting their language. They stop discussing profits, cash flows, and returns on capital. Instead, they emphasize vision, potential, and total addressable markets. And investors reward them with higher prices for using the right buzzwords. That's dangerous. When a company can add billions of dollars in market value simply by mentioning artificial intelligence on an earnings call, you're no longer analyzing businesses, you're participating in a psychological phenomenon. And speaking of psychology, bubbles are built on one core human emotion: fear of missing out. I've watched fear of missing out turn sensible people into speculators. I've seen doctors, teachers, and factory workers pull money from savings accounts and put it into the latest hot stock because they heard a neighbor doubled their money. It happened in 1929. It happened in the dot-com era. It happened in 2006 with housing, and it's happening again today. The technologies have changed, but the psychology has not. I'll share a story I've told before because it illustrates the final stage of a bubble perfectly. In the late 1990s, as internet stocks soared, I received letter after letter calling me outdated, irrelevant, and out of touch. People said I didn't understand technology. They told me I was missing the greatest wealth-creating opportunity in history. One man wrote that my refusal to buy dot-com stocks meant I had lost my ability to invest. Well, 2 years later, most of those companies no longer existed. My methodology hadn't changed. The bubble had simply popped, and that's the thing about bubbles. You don't need to predict the exact moment they burst. You just need to avoid the madness while it's happening. Because the final stage always ends the same way. There's a sudden loss of confidence, and prices fall faster than anyone expects. What takes years to build can unwind in months, sometimes in weeks. And the very people who were shouting "this time is different" are the first to panic. Let me give you another sign of the final stage. When companies begin stretching their accounting, you know the end is near. In the last year alone, I've seen more adjustments, more add-backs, more creative definitions of profitability than I've seen since 2007. Earnings before interest, taxes, depreciation, amortization, stock-based compensation, restructuring costs, and whatever else they decide to exclude this quarter that's not real earnings. That's storytelling. And bubbles thrive on storytelling. You might wonder, if all these signs are so obvious, why do people ignore them? The answer is simple. It feels good when your portfolio keeps going up. It feels good to believe you're smarter than the market. It feels good to imagine that you've discovered a shortcut to wealth. And in the final stage of a bubble, everything feels good right until it doesn't. There's an old saying that markets take the stairs up and the elevator down. But in the final stage of a bubble, the market isn't taking the stairs up, it's taking the escalator. Slowly, effortlessly, almost mechanically moving higher. People get used to the ride. They think the escalator will keep going forever, but escalators end. And when they do, you need to be prepared for the sudden jolt when your footing disappears. Now, let me talk about something that rarely gets discussed but plays an enormous role in the final phase of a bubble: liquidity illusion. In good times, everyone believes they can sell whatever they own at the push of a button. But in stress markets, liquidity dries up instantly. During the 2008 crisis, assets that supposedly had deep markets suddenly had no buyers. In March 2020, entire segments of the bond market froze. People assume liquidity because they've only seen markets function when everyone is optimistic. But liquidity is like oxygen. You don't notice it until it's gone. In this final stage, companies with the least stable foundations often attract the most enthusiastic buyers. I've seen this pattern again and again. When speculation peaks, fragile companies rise the fastest. They're like fireworks, flashy, exciting, impossible to ignore. But fireworks don't stay in the sky. They explode and disappear. I prefer owning businesses that behave more like bricks. They don't fly, but they don't vanish either. There's another troubling sign that we are nearing the peak. Buybacks are slowing. When companies stop buying their own stock, it's often because they know something investors don't. Executives understand their business better than anyone. When they hesitate to repurchase shares at current prices, it's a clue. And right now, many companies that spent years aggressively buying back stock have pulled back significantly. That should make you wonder why. The final stage of a bubble also produces what I call synthetic prosperity. People feel richer, so they spend more. They take on more debt. They buy houses they can't afford. They invest in things they don't understand. But synthetic prosperity isn't real wealth. It evaporates the moment asset prices decline. And when it evaporates, it leaves behind something much more painful: the realization that your lifestyle was built on temporary gains rather than permanent earnings. So, what happens next? I don't pretend to have a crystal ball. I've never needed one. Predicting the exact timing is impossible, but identifying the environment is easy if you've lived through enough cycles. And the environment I'm seeing today is unmistakable. We are in the final stage. The enthusiasm is too high. The valuations are too stretched. The expectations are too unrealistic, and the risks are too ignored. When people ask me what the trigger will be, they expect something dramatic: a massive bankruptcy, a geopolitical shock, a catastrophic earnings miss. But bubbles rarely burst because of a single event. They burst because the underlying structure becomes too fragile to support even a small disappointment. All it takes is one company missing earnings by a few percentage points, or one policy change that squeezes margins, or one unexpected jump in interest rates. When valuations are reasonable, the market can absorb these things. When valuations are stretched to the breaking point, the market can't absorb anything. You may think I'm speaking in abstractions, so let me give you a concrete example. When companies trade at 10 or 15 times earnings, an earnings miss causes a manageable decline. When companies trade at 30, 40, or 50 times earnings, an earnings miss can erase a year's worth of gains in a single afternoon. That's not speculation, that's arithmetic. And right now, there are dozens of companies priced for perfection. That's why I say we're in the final stage. The whole system is built on perfection, and perfection is rare in business. Another sign of the final stage is what I call valuation migration. Investors who once insisted on profits and stable cash flows slowly convince themselves that these things no longer matter. They move from buying profitable companies to buying companies with rising revenues, then from revenue growers to companies with user growth, then from user growth to companies with no growth but a popular narrative. Step by step, they drift away from rationality without even noticing. And by the time they realize how far they've moved, it's usually too late. I saw this very clearly in the late 1990s. At first, investors bought profitable technology companies. Then they bought companies with strong revenue growth. Then they bought companies with no revenue but promising websites. Then they bought companies with no website but a .com in their name. When people ask me how bubbles reach absurdity, the answer is simple: slowly at first, then all at once. And we're beginning to see the same pattern today. Companies that have barely achieved profitability are being valued as if they are guaranteed to dominate entire industries. Companies that rely on generous financing are being priced as if borrowing will always be cheap. Companies that haven't generated $1 of free cash flow are being treated like they've already succeeded. This is the mindset of the final stage, when investors stop asking hard questions because they fear the answers will ruin the party. There's another element at play here that many investors underestimate: regulatory risk. In every final stage bubble, investors assume regulators will stay quiet, but they rarely do. In 1929, new margin regulations limited speculation. In the early 1970s, accounting reforms changed how earnings were reported. In 2000, antitrust concerns shook the largest companies. And in 2008, the entire financial regulatory framework was rewritten. Today, with artificial intelligence, data privacy, and market concentration dominating headlines, it is naive to assume regulators will sit on the sidelines forever. People forget that when the government intervenes, it doesn't matter how great your business model is. A single regulation can erase billions in expected value, and yet the market prices many companies as if they will operate in a vacuum forever, free from scrutiny. That's not how the world works. It's certainly not how Washington works. In the final stage of a bubble, people create ideal worlds in their minds and then invest as if those worlds are guaranteed to exist. Let me tell you something else that concerns me. The amount of leverage in the system right now is extraordinary. Personal debt, corporate debt, government debt, all are at historic highs. And leverage magnifies everything. When asset prices rise, leverage makes people feel smart. When asset prices fall, leverage makes people feel desperate. I've watched leverage destroy fortunes faster than any bear market ever could. And right now, leverage is being treated like a harmless tool rather than the dangerous substance it is. Margin debt in particular is a silent killer. When markets rise, people borrow against their positions, assuming the good times will continue. But markets do not warn you before they decline. A 5% drop can become 10%, and 10% can become 20%. Margin calls begin. Forced selling follows. And forced selling is not rational selling. It's mechanical, automatic, and emotionless. Forced selling creates downward momentum, and that momentum feeds on itself. This is how final stages become crashes. I often hear people claim that this generation of investors is smarter because they have more information. But information isn't wisdom. In fact, too much information can make people more confident than they should be. A person with thousands of data points can still misunderstand the one data point that matters most: price. Price determines your margin of safety. Price determines your future returns. Price determines whether you're investing or speculating. And right now, prices are telling a story that few people want to hear. Let's talk about sentiment, because sentiment drives markets more than any mathematical model admits. Sentiment is incredibly high today. People believe the economy will remain strong indefinitely. They believe artificial intelligence will solve every efficiency problem. They believe companies will keep growing at double-digit rates. They believe interest rates will fall. They believe government spending will continue indefinitely with no consequences. They believe recessions are short, recoveries are long, and the Federal Reserve will catch them every time they fall. But history shows something different. History shows that sentiment peaks at the exact moment risk is greatest. In 1929, economists predicted a decade of prosperity. In 2000, analysts predicted the internet would double productivity overnight. In 2007, bankers claimed the housing market had eliminated risk. And right before every major crash, the consensus view was that things could only get better. That's the sound of the final stage where optimism becomes delusion. What worries me most is that long-term investors are abandoning long-term thinking. People who once bought companies based on fundamentals are now trying to trade momentum. They're trying to catch short-term trends. They're trying to time entry points within days or even hours. That's not investing. That's guessing. And the final stage of a bubble encourages guessing because guessing works until the moment it doesn't. And here's the part most people won't like hearing. When this bubble ends, not if, but when the unwinding will be faster than most people expect. Modern markets move at incredible speed. Algorithmic trading doesn't pause to think. ETF outflows don't stop to evaluate fundamentals. High-frequency traders don't reflect on valuations. When the shift happens, it will happen swiftly. Most investors won't react in time. They never do. When the final stage unwinds, it doesn't feel like a normal market decline. It feels like a shift in gravity. Prices fall faster than they rose. Confidence evaporates. Narratives collapse. Stocks that were considered untouchable suddenly lose 10%, then 15%, then 20%. Analysts scramble to update their models. Investors demand explanations that no one can provide. And all the certainty from the months before disappears in days. I've watched it happen more times than I can count, and each time the pattern is identical. The most dangerous period is the first phase of the decline, because investors refuse to believe it. They call it a healthy pullback. They call it a buying opportunity. They tell themselves that nothing has changed. They blame short sellers, the media, the Federal Reserve, or geopolitical noise. Anything but the truth. And the truth is simple. Once the final stage begins reversing, optimism alone can't hold up prices. The air starts leaving the balloon, slowly at first, then rapidly. And once it leaves, it doesn't come back just because people want it to. During the dot-com collapse, many companies fell 80% or more while investors kept telling themselves the bottom was in. In 2008, banks insisted their balance sheets were strong even as they were weeks away from insolvency. In 2020, the market dropped nearly 35% in less than a month because uncertainty overwhelmed optimism. This is not new. It's not complicated. It's the cycle investors are always surprised by but should never be surprised by. You might wonder what makes this moment different from the past few years. After all, we already saw sharp declines in 2020 and again in pockets of the market in 2022. So why do I call this the final stage now? Because this is the first time we've seen extreme valuations, extreme concentration, extreme optimism, extreme debt, and extreme expectations all happening at once. One of those factors alone isn't enough to cause a major problem, but when they converge, the risk multiplies. Imagine a bridge built to support a certain weight. It can handle a car, maybe a truck, maybe even two trucks at the same time, but not when the bridge is also rusted, when the foundation is weak, when the weather is severe, and when the engineers are overconfident. It's not one thing that causes collapse, it's everything. That's where we stand today. The financial system feels sturdy because nothing has gone wrong recently, but stability without underlying strength is simply calm before the storm. Let me talk about something I've emphasized for decades, something many investors hear but rarely internalize. You don't need to swing at every pitch. You don't need to invest in whatever is hot. You don't need to chase returns. In fact, the greatest advantage you have as an investor is patience. Patience costs nothing and yields everything. But during the final stage of a bubble, patience feels foolish. People see their neighbors' portfolios doubling. They see overnight millionaires popping up on social media. They see momentum everywhere. And patience begins to look like missed opportunity. But opportunity is not something you chase. Opportunity is something you wait for. When markets are priced for perfection, waiting is prudent. When markets are priced for panic, buying is wise. The problem is that people reverse those behaviors. They buy in euphoria and sell in fear. And that's why bubbles are so profitable for the patient and so devastating for the impatient. I've always said that you should be fearful when others are greedy and greedy when others are fearful. Right now, people are very greedy. They may not call it that. They call it optimism or conviction or belief in technology. But the underlying behavior is greed. And greed blinds people to risk. It convinces them that bad things are impossible. It tells them that downturns are temporary and gains are permanent. But nothing in the market is permanent, not gains, not losses, not leadership, not cycles, not trends. Some people worry that warnings like these are pessimistic. I don't view them that way. I view them as realistic. Pessimism says everything will fall apart. Realism says things can fall apart and prepares accordingly. I've lived long enough to know that preparation is not negativity. It's responsibility. And the responsibility of an investor is not to believe everything will go right, but to protect capital if things go wrong. You should know something else. When the final stage begins unwinding, the greatest opportunities emerge. I'm not here to tell you that the world is ending. The world is not ending. American business is not ending. Innovation is not ending. Human progress is not ending. But inflated prices end. Excessive speculation ends. Unrealistic expectations end. These endings create the conditions for new beginnings, but only for those who preserved capital rather than risking it recklessly. Think back to 2009. Investors who kept their composure and held cash were able to buy world-class companies at bargain prices. Think back to 2003. Think back to 1982. Think back to any major bottom in history. The investors who prospered were not the ones who chased bubbles. They were the ones who waited until the bubble was gone and rationality returned. So if you want my honest view, and people usually do when they ask me about bubbles, here it is. We are in the final stage. I can't tell you whether it ends tomorrow, next quarter, or next year. No one can. But every signal I've relied on for more than 6 decades is flashing the same message. This market is priced for flawless execution in a world where flawless execution does not exist. And when the gap between expectations and reality becomes too wide, the bridge collapses. Preparation right now means several things. First, avoid paying 30, 40, or 50 times earnings for businesses growing at single-digit rates. That's not investing. That's wishful thinking. Second, keep cash on hand. Cash is not trash when assets are overpriced. Cash is optionality. Cash is the ability to act when others cannot. Third, focus on businesses with strong balance sheets, real profits, durable moats, and reasonable valuations. Not exciting businesses, durable ones. Durable will beat exciting when the air comes out of the balloon. And perhaps most importantly, keep your emotions out of the process. Markets are voting machines in the short run, but weighing machines in the long run. In the final stage of a bubble, the voting becomes absurd. Prices rise because they were rising yesterday. But eventually, the weighing machine returns. It always does. And when it does, price and value reunite, sometimes gently, sometimes violently, but always inevitably. I've studied markets for more than 70 years, and I can tell you with complete certainty that this cycle will end the same way all cycles do. With disappointment for the impatient and opportunity for the prepared. You don't need to predict the storm. You just need to build your ark before the rain starts. And the clouds forming right now are darker than most people realize. If you stay rational, stay patient, and stay focused on value rather than noise, you will not only survive the final stage of this bubble, you will thrive when it is over. Because the end of every bubble is the beginning of the next great era of opportunity, but only for those who preserve their capital while others chase illusions. The storm is coming. It always comes. The question is not whether it arrives, but whether you're ready when it does. And readiness has nothing to do with prediction. It has everything to do with discipline. If you remain disciplined now, you'll look back on this period not as a time of fear, but as the moment that set the foundation for your greatest investments.